Awesome. I think everyone can hear me clearly. I'm just doing a quick sound check. So if you guys can hear me, just put thumbs up. Okay, awesome. I think we'll begin. We'll just wait for 30 seconds so that people can join and everything syncs up. And then we can begin. Okay. I'm very excited for today's video, mainly because I've been following Mr. Alok Jain from I think 2.5, 3 years right now. And I'm a big fan of his momentum investing strategies as well. So today we're going to understand all of that because even I have like a lot of questions here on momentum investing. How does it work, etc. But we'll get into that, I think, as soon as we start the session. And I think we can go. So I'll give you guys a very quick introduction, right? So Alok Jain is the founder of Weekend Investing. He has been in the Indian stock markets for more than 2.5 decades now. And he's also passionate about building mechanical trading and investing models to basically invest in the market that can give you really good returns. Now, his dream is to be able to like help everyone achieve financial independence early so that we can live our life in full and enjoy like him as well, right? Now, he has also set up the first national stock exchange memberships in New Delhi in 1996. And for 2 decades, he's been in institutional, corporate, HNI, and retail clients. He's serviced all of them. And along the way, has also developed a keen sense for systematic rule-based investing systems and technical trading. Now, I'm very excited to start this entire journey, and I'm sure you guys also have a lot of questions. So what we'll do is we'll quickly first, hello, Alok sir, how are you? Wanted to do this introduction for you first.
Thank you so much for the very kind introduction, and it's a great pleasure to be here on this AMA. And I'm excited that so many people are joining, and we'll be able to walk through momentum investing and its nuances with you today.
Perfect. So guys, let me explain this, right? So momentum investing is something that everyone has been talking about recently. There is a lot of it. It doesn't seem very easy. It is slightly technical as well. But today I have a lot of questions as well. And Alok sir also has made a beautiful presentation so that all of us can go through this and understand it from groundwork, right? So we will ask any questions at the end of the session. But first, I would like Alok sir to actually present the presentation so we can understand what momentum investing is. And guys, I want you to keep dropping any questions that you have in the chat as well, because we are going to pick up the small case team, and I am going to pick up all the questions so we can ask Alok sir in the end. Okay, awesome. Over to you, Alok sir.
Thank you, Shashank. So the presentation I have here is more geared towards using momentum, how to beat Nifty 50, but I'll give you a very brief introduction about momentum itself. So momentum is essentially a phenomena that, just like the Newton's law, that when an object is in motion, it continues to, stay in motion until a opposite force is applied to it. Similar to that, the stock prices tend to remain directional until, that directional trend ends. So if a stock is moving up, it tends to keep moving up for some time. If a stock is moving down, it tends to keep moving down for some time. So the idea is to use this physics in the market to determine which stocks are in trend, which stocks are going up, because we are playing long only. So I'll only talk about stocks going up and not talk about shorting stocks. But if we are able to identify stocks which are having momentum, and we can define momentum in various ways. I mean, we can measure momentum, for instance, using rate of change. So today's price versus, let's say, 12 months back, what is the rate of change over that 12-month period? That tells us the relative ranking of one stock versus other. Maybe Reliance has done better than State Bank, better than L&T. So the relative momentum ranking is known to us by using ROC, or rate of change. You could also use some other indicators like RSI, or you could use, maybe the distance from 200 DMA as a measure. So the measures could be any, but the whole idea is to figure out that, let's say, within a universe of 50 stocks, where does one stock stand in relation to the other? So in a 50 stock ranking, I have these top 20 stocks, then we have another 20 stocks which are not doing so well, and 10 stocks are really doing bad. So I need a quantitative measure of how to rank stocks. So momentum in general is a very quantitative way of addressing investing. So we create a portfolio just like a conventional portfolio. So we have maybe like 20, 25, 30 stocks, 10 stocks in a portfolio, and we'll allocate equal weight to each of these stocks. But then we will use this ranking of how well they have done over the last 3, 6, 12-month period to select stocks out of that group. And that's what creates the basis for selection or for deselection from that group. So as we go through that example, you'll get it very clear. But the whole idea of this particular presentation is to see that with Nifty 50, we have 50 stocks, but not all 50 of them may be performing at any point of time. There may be 10 to 20 stocks that may be performing really well. 10 to 20 stocks may actually, just being sideways, and 10 stocks may be doing really badly at any point of time in Nifty. So from that perspective, when we look at investing in Nifty, we are actually having to buy all these pockets of strength, pockets of mediocre movement, and pockets of weakness. So the idea of this presentation is to show you how we can eliminate the pockets of sideways movement and of weakness. Now, the main issue of just investing in Nifty and having a very long-term sort of goal with it is the only issue of high drawdowns in Nifty. What is a drawdown? Drawdown is basically the fall witnessed from any point. So if Nifty has reached 10,000 and it falls to 7,000, that means it has had a drawdown of 30%. This kind of movement from the top to its next bottom, the drawdown, can be extremely severe even in the case of Nifty. For instance, in early 2000s, we had a 50% fall in Nifty. In 2008, we had a 60% fall in Nifty. Then in 2012, we had a 28%, 27%. Recently, in COVID times, we had a 38% fall. What this does is that usually investors are unnerved by such falls, and they will either get out of the market or they will throw away their position and try to get in at a later point. So all this huge volatility actually scares away most investors. And what we are trying to do is to reduce this volatility in our portfolio and to remove the weakness in stock. So just for an example, we'll take stock of Vedanta, for instance. Now, Vedanta stock was there in Nifty from early 2000s. But after 2010, it had a very dramatic fall till 2016. So it fell from, let me just see here, from around 500 rupees down to as low as nearly 50 rupees. And after this fall from 500 to 50, 90% fall, did the Nifty remove it from its index? So while the stock was falling all this while, we were forced to remain invested in Vedanta through our Nifty ETF, through our Nifty index fund, but we had no option to opt out of it. And then when it started to go back up from 50 to 300 rupees, then somewhere around 250 or 210, Nifty added it back to the Nifty 50 constituent in sometime in 2017. And then it had another 80% fall after that, from 360 to 40, 50 rupees again. Then again, the Nifty committee removed it from the index. So you are able to see how one stock, while it is going up and down, the component of it contributing to Nifty has been negative. So Nifty had held it while it was coming down. It did not hold it while it was going up. And then it was holding it again while it was coming down. So your Nifty performance was actually getting impacted really badly because of this one stock, for instance. Another example could be Punjab National Bank, where it was in Nifty since eons. But after 2011, it hit to 280 rupees and it has been falling since then, now 37 rupees. And it only came out of Nifty once it hit 80 rupees. So this fall from 280 to 80 was encompassed in the Nifty itself. So Nifty had to bear the brunt of PNB falling before it was removed out of Nifty. So late exits from the Nifty hurt Nifty performance. We see 12 to 14% long-term Nifty performance, including dividends. But just imagine if all these laggards were not a part of the performance, Nifty performance will be much, much higher, because these weights and sometimes heavy weights create a drag on Nifty. This is another example. Vodafone was part of Nifty. It went to 120 rupees. And then from there, it crashed to 40, 50 rupees, after which it was removed to Nifty. And of course, from there, it fell to further 10 rupees. So again, this entire fall of 60%, Nifty bore the brunt of the Vodafone fall. So also during COVID times, you would have seen what kind of drops we saw. So this is just a list of 50 stocks from the Nifty in the COVID times. And you can see the kind of dramatic drops each of these Nifty constituents had. IndusInd Bank dropped 80% between 1st January and 31st March 2020 in the COVID quarter. Tata Motors dropped 67%, Hindalco 60%, Axis Bank. So many of them were up more than 40-50% drops. What if you could have avoided a significant portion of this drop and still held Nifty stocks? So that is the whole idea of, having a shallow drawdown. And I'll give you a very sort of daily life example of a shallow drawdown. Is that, let's suppose you are running on the road and you fall into a ditch. Now, if that ditch is 2-3 feet deep, you will get up, you'll brush yourself off and you'll start running again. But what if that ditch is 20 feet deep? It will be very difficult to get out of it, and you probably are injured already, and you'll probably not be able to get out of it and start running again. So that's the same thing that happens with deep drawdowns in our portfolios, that the deeper is the cut in your portfolio, the more difficult it is to come out of it. And if you are able to reduce your fall significantly, then the next run that you will have will add extremely good returns to your portfolio. So let's say you start at 100 and you dropped 50%, you came to 50. Now you made 100% on your next move. You're back at 100 again, right? But what if you went from 100 to 80 and then you make the next 100% move? You would have gone to 160. So the impact of drawdown on your next up move is humongous, which we don't realize normally. But because of these laggard stocks in Nifty, we are actually impacting the performance of Nifty in a huge way. And we want to reduce this drawdown so that the returns to break even and further moving up go very, very fast. Another very big factor in index investing is that the highest weighted stocks always have 50 to 60% weight of Nifty. So 10 highest weighted stocks of Nifty command between 50 and 60% of Nifty in the last 15 years of data that we have. So what it is happening is that only 40 stocks are having 40% weightage, whereas 10 stocks are having 60% weightage. What if most of these 10 highest weighted stocks remain in the non-performance bracket? Let's say Reliance doesn't perform for 10 years. Let's say ONGC does not perform for so many years. Let's say Infosys does not perform for so many years. Why should we allow a heavyweight to impede the performance of our portfolio just because it is a heavyweight? And hence, these stock weightages play an important role in the index performance. So to come out of all these factors and improve on the index performance, we've designed a strategy where you'll be able to get the strength out of the Nifty stocks, whereas leaving the weakness out of it, and have smaller drawdowns and not have this weightage sort of bring you down in terms of non-performance. So we have a strategy called India Top 10, and I'll just very briefly run you through it in the next 2-3 minutes. So what we do is that we select the top 10 trending stocks from the Nifty universe. So out of the 50 stocks, we will do a ranking, just like I said, every month, and we will select the top 10 trending stocks. The next month, again, we will do a similar ranking and see if that strength is sustaining or have 1 or 2 stocks weakened. In case 1 or 2 stocks have not retained the strength in the ranking, we will remove those stocks and bring the new stocks that have replaced them. So you will always have 10 stocks which are having the highest momentum on a monthly basis in Nifty. The aim is to outperform the benchmark. The aim is also to significantly reduce the downside. So the pain has to be reduced so that you can do the longer jump, as I mentioned earlier. And also to do very low churn. So in a stock portfolio of about 10 stocks, you'll probably do like 7, 8, 9, 10, 11, 12 maximum sort of trades in a year. And because these are Nifty stocks, there are no questions of slippages or anything like that. And the basic tenet is that we allow winners to run far, and you are losing the losers very, very quickly. This is actually the main reason why momentum investing strategies win, because you are not biased. There is no emotion involved. There is no bias involved. There is no guesswork or forecast or prediction involved in this. It is purely a data science experiment where you are saying that once a stock is performing, we will allow it to perform till the stock tells you that I am not performing. You are not putting your own assumption as to where you should get out, where you should get in, which stocks you should buy. You're allowing a tested systematic system to tell you what to buy, when to buy, how much to buy, and when to sell. These are the 4 tenets of momentum investing that you need to absorb. Results last 6 years, if we were running this strategy, you would have got an absolute return of 242% pre-tax versus Nifty of 131%. So a huge difference in the CAGR of such a strategy at 21% versus 14% on Nifty. A huge difference in the drawdown. So minus 24% is the maximum drop from any point in the strategy, whereas in Nifty since 2016, this data is since 2016, is the maximum drop has been 38.4% in Nifty. And there's something called the ROMAD ratio. So returns over max drawdown. This measures how is the gain to pain sort of ratio for a strategy, so that you are having a balanced approach. You don't want too much pain for too much gain also, and you don't want too less gain for a lot of pain also. So ROMAD ratio, if it is high, means the strategy is doing much better than the one which is below it. And Nifty's ROMAD ratio is 0.36 and MI India top 10 is at 0.87. So huge improvement on the Nifty itself. This is how 100 rupees invested in 2016 would have looked like on the Nifty. You would have reached at 226. And this is how it would have looked like on the strategy. You would have reached 340. So you can see that gradually in each year, the gain is gradually increasing, and it dramatically moved up in 2021, 2022, because it performs the best when the market is in strong trend upwards and a momentum is there. These are some of the biggest winners of this strategy. So you can see here that the biggest losers in the strategy are in the 16, 20, 30% range, whereas the biggest winners are in 60, 70, 80, 90, 100% range. So you can see that you're allowing winners to run, whereas the losers are being cut out at a much lower pain point than the winners. So the idea is that wins should be big and losses should be small. That's how the whole math will come around. Now, the couple of examples about how some of the stocks were able to perform in this strategy. So let's say a Yes Bank here. Now, many of you probably will not know that Yes Bank was a part of Nifty until very recently. And the strategy entered somewhere around 166, exited around 307, never looked back. But Nifty carried this stock till this point in 2020, where it removed it from the Nifty constituent at somewhere near 20-30 rupees. So 400 to 20-30 rupee type of fall was seen before it was removed from Nifty. And you can imagine the kind of pain this had to bear, the Nifty index had to bear because of Yes Bank. And every person who was holding Nifty ETF, Nifty index fund, anything related to Nifty was having a exposure in Yes Bank because of it. But you could have avoided that if your strategy was looking at the strength in the Nifty. Another last example is about Yes Bank again here. No, this was one second. So this was Yes Bank. There was another example here. Yeah, India Bulls Housing. India Bull Housing was also a part of Nifty. I mean, when we don't look back too far, we feel that these stocks must have never been in Nifty. But there has been all kinds of stock which entered the Nifty. The Nifty has changed about 30-40% time. 30-40% of Nifty has changed in the last decade or so. So Nifty is churning. Nifty itself, you must understand, is a momentum portfolio. So the Nifty committee meets twice a year and they will suggest certain rebalances. So 2 stocks out of Nifty, 2 stocks into Nifty, like you would have heard recently that Adani stock, Adani Enterprises coming into Nifty. So Nifty itself is a momentum portfolio. The best performing stocks will be brought into the Nifty, and the stocks that are not performing well will be removed from the Nifty. You can count the names: JP Associates, Yes Bank, India Bulls Housing, Vedanta, Indian Oil Corporation. All these otherwise good companies at their time were removed from the Nifty because they stopped performing, and Nifty, because it has to perform like a momentum fund. Hence, these top performers are brought into the Nifty. So again, the example here, India Bulls Housing entered somewhere around 1,000 rupees, exited around 1,200, not much of gain, but just see that it came out of Nifty at 250, 300 rupees. So this entire fall of 1,400 to 300 would have been avoided if you were not holding, India Bulls in your portfolio. So just a very short sort of glimpse of how selection of good Nifty stocks can help you improve over Nifty. And this was only an example of the Nifty, but in general, if you look at momentum investing, the basic tenet is that you want to hold strength. So you have to identify strength in the market and you want to hold that. And by this virtue, what happens is the sectors which are getting strong, now there is a sector rotation happening. So every few months, some sector or the other will start leading and others will, rotate down. So because of this strategy, you will automatically already have the sectors which are in strength, and those stocks will come into your portfolio by the way of the churn in this. So I think turn it now back to Shashank, and we can carry on from there for the Q&A and the rest of the session.
Awesome. I think there are a lot of comments as well regarding this, that the way you explain things is so logical and very neutral that it's very nice to hear you talk about all of this. And also, I think there's one thing that a lot of people don't understand or have not seen this before is when you talk about Nifty itself being a momentum play. And we see a lot of these rejigs happening in Nifty. And I think now everyone knows that, okay, yeah, Adani is coming. So that became a big news into the entire Nifty thing. But over time as well, if you see looking at the falls that people have gone through with passive index investing kind of a thing, that also looks a little scary now from that point.
Exactly.
So what we'll do is we'll take a few questions from the audience.
Sure.
And we'll just ask some questions from them, right? So I think one question that was there, and this was a question from Akshay Bailkari, right? So he's saying, when you talk about a momentum strategy, can you do SIPs? Can SIPs work in momentum strategy? Because there's a lot of rebalancing happening there. So does SIP work in this strategy?
So the first thing that I want to make clear is that momentum need not be short term. A lot of people associate momentum with short term trading or high churn. It need not be this way. It all depends upon how you're designing the momentum strategy. Momentum can be done in 50,000 ways, just like conventional value investing, growth investing can be done in so many ways. There's no one way of doing it. So momentum investing is also, depending upon your design. So you can design a strategy where you have low churn. You can design a strategy where you want the universe only to be Nifty, universe only to be CNX 200. You can design a strategy where, you want to take only stocks which are above a particular market cap or above a certain liquidity level, average weekly, turnover. So it all depends upon how you design it. But coming back to the question, what was the question again? Sorry.
The question is, if you do SIPs into momentum-based investing with rebalancing, does it work in your favor or
so it
not?
works very well. I mean, we have thousands of people who are doing SIP rebalances in our small cases, and you can invest the initial amount initially, and it will allocate to the momentum portfolio. And then from then onwards, you can do a monthly SIP if you like, you can do a weekly SIP if you like, and it will add to the portfolio accordingly. So SIPing is not taboo at all. And in fact, SIPing is the best way to come in gradually into the market. I always advise, don't bring in lump sums. Come into the market SIPing, because you never know where you are near an intermediate top, and you don't want pain in your investing, journey. So come with SIPs, come with maybe lump sum amounts at intervals, but don't jump in with all in at any point of time.
Awesome. Perfect. I think there's another very nice question, which was very close to what you were talking about in the presentation by Jay Rao, right? And Jay Rao is asking, what if the 10 low weighted stocks in Nifty have a higher momentum than the other Nifty stocks? Can they still outperform the Nifty index returns, or will that not happen because the weightage is so off in the Nifty-50 index?
So good question. When we are in our instance of design, we are keeping all the 10 stocks equal weight. The stocks that are going to be selected based on the best momentum will be kept equal weight in our portfolio. So rather, if they were in part of the Nifty, and let's say the top 10 only constituted 10% of Nifty weight, despite their performance, Nifty would not have got impacted as much. because Nifty would not move despite those 10 stocks performing. Whereas in a portfolio which is concentrating on performance would really move very fast compared to the Nifty based on that.
Got it. Got it. Got it. I think there was another question as well from Gautam Kashyap, a very interesting one. So he's asking, how does one treat the momentum at threshold levels, right? So will the momentum cross over or will it just get restricted at the threshold level? So I think this is more on the lines of, when do you think about exiting? Does the momentum play find out the right barrier to exit and not cross the threshold?
I'll tell you, usually what happens is that in a relative, like momentum also said many ways of doing it. There's absolute momentum, there's relative momentum, there's dual momentum. I don't want to get into so much detail on momentum, but the whole idea is that you are having in relative momentum, for instance, a list of stocks, your universe, which you are ranking based on certain criteria. Based on momentum of price, momentum of RSI, momentum of whatever position versus each other, so on and so forth. Now, once you have a ranking, then it is very easy for exits to happen. Let's say you are saying, I'm going to take the top ranks, top 10 ranks. So a stock drops to 11th or 12th, you will chuck it out at the next rebalance. And the stock that has replaced it, you'll add that back to the portfolio. So what that happens is, it's almost like survival of the fittest. You know, you are not having any bias that whether I should remove or not, whether how this company will do well or in the future or not. You are just having a very mechanical process that this is my algorithm, and if it drops below, I'm getting out of it. No questions asked, and if something comes in, I am bringing it back in. And once you stay with the strength, the performance actually automatically happens. And you know, there is 200 years of data that has been studied, research. There's academic papers on it. Momentum factor investing is the best format of investing. Unfortunately, because it is very simple in terms of you know, its creation, that people don't want to believe it. Just like I'm saying, I mean, if you just rank stocks and invest and you'll win, people don't want to believe it. I mean, it's as easy as saying that, you know, we all know that if we go and jog for 5 kilometers, we'll all be very healthy every day. But it is simple, but is it easy to do? No, it is not. So the same way, the momentum strategies are very, very simple. You don't really need anything else. But it's not easy to do because they're counterintuitive, because stocks will be running hard when you enter them. Normally, people are exiting at that point of time where momentum investors are entering. So it is, you know, a bit counterintuitive, because we've been taught from our childhood, buy low, sell high. So it becomes very difficult for us to buy high and sell higher. It's like wo chalti bus mein chadna, you know, running and catching a fast bus. I mean, we are afraid of that. So that's the sort of thing that you need to do once you get familiar and, you know, adjusted to this strategy.
Got it. I think that's very interesting, because you're going to rank it, and now, as you said in the previous thing, right, there's no bias when you invest in these stocks. Absolutely. Because it's ranked, you're in ranked well, you're out of the portfolio. Yeah. Beautiful. So Ayush Rajput has asked another very interesting question. He's saying that will this strategy also work in a bear market? Because there the momentum may be slightly lower. I don't know how it works there. Will the returns be slightly different? I mean, you've seen that as well, right? Could you explain a little bit on that?
So momentum will work beautifully in bear markets also. I'll explain you why. Now, let's say Nifty has dropped 38% in COVID, right? And let's say your strategy is to select the strongest of the 10 of the 50 stocks of Nifty. Now, if Nifty has dropped 38%, there will be stocks that have dropped 50, 60, 70, 80%. And there will be stocks that would have dropped 10, 20, 30%. Right? That's why the average would have come to around 38% weighted average. So your strategy will go to the strongest losers. If you get my point here, that yes, everything will be falling, but your portfolio will be choosing the least hit stocks. So, you know, when market falls, money automatically moves to defensive sectors like FMCG, like pharma, like IT sometimes. So when money moves to defensive sectors, it gets out of high risk sectors, you know, like steel, automobiles, energy, so on and so forth. So automatic rotation of sector will happen, and you'll move to the least hit stocks within the Nifty, and hence your fall in this portfolio will be lower than the Nifty. So even though it's a bear market, you are performing better than Nifty, although you are also bleeding a bit. But as soon as the market takes the U-turn from the bottom, and the first few sectors which are leading the rally, which are different every time, sometimes pharma will lead the rally, sometimes metals will lead the rally out of a bottom. You will be the first one to get into those sectors because of your measurement of the ranking. And hence you go into a curve down, doing better than Nifty, and you come out flying above Nifty performance. So it actually works both ways, in markets going up as well as markets coming down.
Wonderful. I think that's very interesting. Yeah, I mean, I've always been trying to understand momentum investing. That's why I've been following you for like 2.5 years. Now, there's a very good question by Sanjay Kapoor, and this is something that I see on the Weekend Investing Small Case website as well, right? Where it says, is there a capital allocation limit to the momentum investing strategy? Because even on the thing, there is a 5 to 20 lakh, 5 minimum, 20 lakh maximum. Can you go over 20, or is it okay below 5? How does that work? I just want to understand.
So what happens on small case platform is that the order execution is a market order driven execution. So let's say if you do a rebalance, and let's say Reliance comes into a portfolio, and you will be nudged by small case that please do the rebalance and add the stock to your small case. When you will execute the order, that order will go as a market order into the market. It will not go as a limit order. It will not say buy Reliance at a certain price. It will say buy Reliance at whatever price is available in the market, right? So what happens is that when there is a large number of people who will be executing the same order at the same time, sometimes a large amount of slippage can happen. So let's say, 10,000 people want to buy, 50 crores worth of some stock. Maybe Reliance can still, absorb it, but maybe a stock which is at a 200 position on the CNX 200 may not be able to sustain it. And it may slip 4-5% for a moment, or for some minutes, so on and so forth. So basically because we are a large manager on small case, we have tens of thousands of people now, with our strategies, we have to very strictly control what is the AUM that is running on our portfolios. And we sometimes even close our portfolios for subscription when we feel that, too much money has already come into a product. And hence we have very stringent limit on the higher side, that please don't go beyond this limit, because it's a calculation for us how much volume each stock can sustain, which we are recommending. And we want to ensure that those stocks don't slip. On the lower side, when we keep a limit, that is for the benefit of the user, that let's say in some strategy, we say, don't come below 5 lakhs. We say that because let's say our cost of entering the strategy subscription is, let's say, 10,000 rupees. Now, if a person comes in with 5 lakhs, the expense ratio on that portfolio will be 2%. If it's a mid-cap, small-cap type of portfolio, which will make ideally 20-25% type of CAGR over a long term, then still you can absorb it very nicely. But let's say if it's a Nifty kind of a portfolio where we are expecting between 15, 17, 20% type of return, there a 2%, 3%, 4% expense ratio will become very, very hard to digest, even for the user. And we don't want that. So we want the person to choose that product where the expense ratios remain between 0.5%, 1%, 2%, not more than that. So if you come in with 2 lakhs, you can definitely come in if you like. But if your expense ratio is very high, it will dent your performance over time. And that will impact your compounding over the years. The idea is not to come into small case with a short-term focus of 2, 6 months or 12 months. Idea is to come into 3-5 year type of time frame where you have a long runway, where you will compound wealth over these 3, 4, 5 years. So hence we try to remain consigned to these limits. But some going overboard the limit is okay. That is not a problem. But don't go multiple times over that.
Got it. I think, guys, I'm going to take a small pause here, because I see that a lot of people are asking me a question saying, what is the name of the small case? So the name of the small case that we showed today is called MI India Top 10. This is by Weekend Investing. Also, I think there is a very special access for only the guys who are attending this live right now. Again, thanks to Alok Jain sir and thanks to Smallcase. So there is a coupon code which gives you 25% off on the MI India top 10, which we're going to put it in the comment section here and we're going to pin it. So for all the people who want to go check out the momentum investing strategy, you should definitely go give it a whirl, give it a spin and see how it works out for you guys, because now we're answering literally every question that you have. And if you have any more questions, you can ask us here. So we're trying to solve everything right now for you guys and trying to understand more about momentum investing. And this coupon code is again only for people who are watching this live stream. So I think you guys are also very lucky because even I didn't get this coupon code at one point. But yeah, awesome. Chalo,
coupon code is top 25, I think.
Top 25, yes. So I think it is pinned on the chat for all the people who are asking. And we will also, I think, Smallcase team, if you can pin the link also of the Smallcase, that would be easier for people to navigate as well. Okay, perfect. Thank you. So now we'll take another question. I think this was very similar to SIP of what you had mentioned, right? So there is a very nice question from, I think Arpit said, who basically said, when you spoke about SIP based investing and it is considered good for momentum based strategies. Now, how do we do an SIP strategy? Do we just keep a simple on a particular date or a particular month, we keep investing from an SIP perspective? Or do we do that staggered approach where if the market falls, we invest maybe 5% more, and if it's going up, we invest 5% less, or do we not worry about that? How would you strategize that?
I think the best strategy is to, just disassociate yourself from trying to, control the investment or the market. Once you've chosen the right vehicle, then just let go, create a system of, doing a weekly, monthly, quarterly, say whatever you like, and just go with the flow. Don't worry about trying to time the market of 5% lower, 5% higher. In the long term, it does not matter. In fact, I am running a portfolio right now live since last about 50 weeks on Twitter, where I've actually started in October 21 and somehow I had a hunch that October 21 was going to be a top, and market is going to fall after that. So I started a new SIP at that point, and I said, let me keep sipping for the next few years and actual showcase in real time how this performance is happening in a portfolio which is normal CNX 200 based momentum strategy, where I was expecting 15-20% type of return over time. But in this, for 50 weeks itself, the XIRR is about 38% on that, because I'm not worried about what day I'm investing in that SIP every week, and what is the situation of the market, whether I'm expecting it down, whether I'm expecting it up. It's a blind basically input every week, because I know over time the strategy is a self-correcting strategy. It will remove weakness, it will bring in strength. I'm not worried about it at all, and that's how you should also do it. Once you've selected the vehicle, don't worry about timing the market, because leave the timing to the professionals. Let the active managers do the timing. Here in weekend investing, we don't time at all. I mean, we are going as per our design of the algos. But even for active fund managers, I mean, they're the ones who can really time it. But I think for all the others, the timing aspect is best left to the professionals.
Makes sense. I think there's another question which came up slightly earlier in the chat by Stavan Bhakta. So they said that they're basically looking for a low drawdown strategy. So they're like, what do you suggest? Should I go for the India top 10 or should I go for the evergreen weekend investing portfolio if I'm looking for a low drawdown strategy?
I think low drawdown, both of these would be somewhere similar. If you can just go and take a look at both the strategies in terms of historical drawdowns, everything is available on the Weekend Investing Hub, and I'll post that link here. We have a hub where we have all statistics every month, every quarter, every year, drawdowns, monthly returns, everything about all strategies at one place, product videos, everything there. So just go there and see what strategies you are interested in. In case you are still wanting to compare them, you send us a mail and we'll do some statistical comparison and send it to you in case that question is there. So evergreen is very good where you are more conservative because it has element of hedging with gold. So we do a 25% allocation to gold in that strategy. So it's more like a asset allocation type of strategy. And this Nifty India top 10 is more geared towards money that was going towards the index investing, ETF or index fund, etc., to improve the performance on the index.
Yeah, I think a lot of people are asking for more strategies. Alok sir, please tell me more strategy. I think everyone loves strategies here. I think if you want to learn more strategies, then you should definitely go check out Alok Jain's YouTube page, because I know he comes live and he talks about it as well. Apart from that, on Twitter, he keeps putting up a lot of things that are happening right now in the market because he's tracking it literally day in, day out, right? So I think you should also follow the right people so that you understand what's happening in this space. And it's not just about which stock you can buy, which will go up, a lot. It's not about that. It's more about understanding what is happening in this space and how you can take advantage of that, right? So this is very important.
Yeah. So what I've done is I've just posted on the chat a link for the Weekend Investing Hub. The second link that I posted. So this link has all the details of all products, all the past performances, drawdowns, returns, product videos, product description, everything is there. Anything about the product is there. So go there. So you need to do mix and match. So some core strategies of large caps like Nifty to India top 10, etc. can be done. Then you can add some mid and small cap strategies, to sort of counterbalance higher risk of some part of your portfolio. And that, of course, your financial advisor can tell you. I'm not allowed also to, give you personal advice on that. But this is how most people are doing that. They will mix and match different segments of the market, high risk, low risk, core, satellite strategies, and create a bouquet of strategies out of that.
Makes sense. And actually, there's another very, very nice question. I don't know who asked this, but what they were saying is we have a monthly rebalance strategy in the weekend investing portfolio, right? Now, does it make sense from a tracking perspective if we do a bi-weekly, like every 2 weeks we do a rebalance? Would that be more accurate? Or do you think monthly? I mean, you build the strategy, so you would know that. But is there a difference if you do it in 2 weeks or you do it after 4 weeks?
So there's a huge difference. Like I said, NIFTY50 is also a momentum strategy of sorts. They do a rebalance every 6 months, right? So if a stock has not done well, the earliest they will take action on it will be 6 months late, right? So as I showed you in many examples, stocks dropped 70-80% before they were moved out. So the advantage of frequent rebalances is that you will do less damage in that time in case something has to move out. But the disadvantage of that is you will incur a lot of churn. So you need to have a balance between these two elements where you want stocks to move out the weakness, but you also don't want too much churn in your on your portfolio. So we have some strategies which are monthly rebalanced. So like India top 10 is monthly rebalanced, NNF10, one of our most popular strategies, is monthly rebalanced. Evergreen is monthly rebalanced. And we have a free strategy, NG5050, which is also monthly rebalanced. And all the other strategies are weekly rebalanced because they have more of mid cap, small cap flavor, where you need to move out of weakness more quickly. Because if you allow a weak stock to bleed for a month, it will take away, the entire capital allocated to it. So this is how the strategies are designed. The strategies which are monthly in nature will have lesser number of stocks. You're allowing more time to them. And strategies which are weekly in nature typically will have more number of stocks because a fast drop also should not hit your portfolio dramatically. So your exposure to each stock will be like 2%, 3%, so on and so forth. So I hope that clarifies the question. If not, drop in a mail and we'll do that.
So again, another question, I think this is by Natraj Madala. So he's saying, hi Alok, I see that the minimum amount to invest is around 35,000, but it's difficult for people who just started earning and they're earning less than 40,000 a month. Is there any chance to bring the minimum investment lower? And more on that, I'll add one point here as well, right? Does it make sense to take a smaller allocation there, maybe a 20-25? I think, will it still hold with the momentum investing strategy?
So most of our strategies, I will not recommend if you're not starting, let's say around 2 lakh rupees, because the expense ratio will kill you. Let's say you bring in 35,000 and the strategy is costing you 10,000. I mean, you've lost 30% of, returns at the start itself. So don't treat it as a trade that you'll come in with 35,000, spend 10,000 on the subscription and make 35,000 and make net 25,000. Don't treat it this way. Treat it in a way that you need to build and compound over time. And you need to come in with a capital where the expense ratio for it, all expenses put together, is not more than a couple of percent. That is one. Two, the minimum that you see on the small case platform is just the minimum so that you can make that portfolio of 20 stocks, even if the least number of stocks in any constituent is 1. So below that amount, you cannot create that portfolio. But that's not the recommended minimum of the portfolio. So there is one minimum which small case platform is showing you. And there's one minimum that I'm recommending that don't come in below this recommended minimum that weekend investing is suggesting. So ignore the platform minimum amount that is showing you. Of course, if you intend to bring it over a few weeks, then you can do, bring in 50,000, then bring in 50,000 in the next week, so on and so forth. But in case you're not able to do that, I would suggest you accumulate your money outside the strategy. Once you have the requisite amount, then you bring it into the strategy. And if your SIP is not able to have that amount, which is required as the minimum SIP, again, accumulate SIPs over weeks or months. Once you have the desired amount to come in as a minimum SIP, then you bring it in as a minimum SIP or an invest more option in this small case.
Got it. And also, I mean, I have a question, right? I wanted to ask this as well. When you talk about momentum investing, how much allocation, I mean, how important is, say, fundamental investing here or technical investing, or do they not correlate at all? Like, is it only on trend-based analysis?
See, Shashank, what is the point here is that it's like I said, it's simple, but it's not easy, right? So you need to allocate some capital first. Let's say you are conventionally, you have invested 100 rupees. Let's say you invest 20 rupees in this.
Yeah.
And run it for a while. See the field, see how it performs versus against your conventional strategies. I can bet that over a year or 2 years, you will move with the entire money here.
Yeah.
Because the fundamental question is that there have been academic research done on it that there is no other format of investing which does better than this. And we've seen it over 6 years of running it for so many thousands of clients. More and more people are getting out of their mutual fund. More and more people are getting out of their PMS and bringing it here because it is performing on the downside also. It is not just the upside, which is, sort of a myth that momentum only performs on the upside.
Correct.
It is performing on the downside also. And the biggest thing that you need to realize is that actually everybody is doing momentum investing, even though they may not be calling it. So let's say you are doing growth investing or value investing. You found a value. But how do you realize that value? Only when momentum comes into that stock.
Yeah.
Right. You found growth, expansion of margins, expansion of market share. So everywhere you are measuring momentum in some form or the other. So actually, everybody is a momentum investor, but just doing it purely on price action based and allowing, fundamental or bias or your own bias not to come into the picture is pure momentum investing. And I can bet anybody who experiences this over 1, 2, 3 years will not look at anything else post that.
Wow, that's nice. And can normal people do this? Like, for example, if I don't have a strategy and I'm just looking at stocks and trying to play momentum, like, for example, Adani's been like the talk of the town and I have no idea when to enter, when to exit. That's one big problem, right? Because I don't have a proper strategy in place, but I look at some particular sector, particular trend. Can normal people do this? If yes, then what do we look at while doing momentum investing? Are there like few things that you say that these are the things you should look at and these are the things you should look at to exit?
So any type of investing you do, whether momentum or anything else, I think if it is a bit quantitative, it will help you create decisions. What happens in conventional investing is that there are 10,000 variables that are moving around. There is macro that is moving around. There's company internals which are moving. There's the management quality that may change. There may be vendors or sector specific issues that may be happening. Government may change policy. Interest rates are changing. There are so many things. You cannot
Correct.
Have a study that will encompass everything and give you an answer. Whereas a quant based strategy will tell you very clearly, a sort of crystal clear way, like I said, what to buy, when to buy, how much to buy, and when to sell. If this is clear to you at any point of time, there is no ambiguity then. I mean, when a stock falls 50%, usually people are stuck like, deer in headlights. What to do now? But what is needed is that while it is falling, you needed to have a plan ahead of that fall. What will I do if it fell 30%? What will I do if it fell 50%? What will I do if this and this happens in the company? So you need to be one step ahead in your planning to execute it in case something goes wrong. Because once something goes wrong, you are not able to execute it. It's basically all behavior and emotion based. I mean, if I take a larger question, why do markets fall? Markets fall because, liquidity dries up. Everything is liquidity driven. When liquidity comes in, market goes up. When liquidity moves out, market comes down. Because nobody has money, that's why market makes a bottom. because it keeps falling. Nobody has money, and then fresh money comes in from somewhere else, and it takes it up. So it's like an auction process that is happening up and down, up and down. So if you see it from a quant perspective, the more clarity you have about how you will enter, how much you will allocate, when you will exit, how you will pick stocks, that should be clear. If somebody is just telling you, buy Adani stocks, don't do all that. I mean, especially if you are not a full-time professional into the market. If you are in some other profession, you're an IT guy, you're having your own career. I mean, my personal belief is you are ruining that career in terms of, trying to trade the market on the side. So give your money to a professional or follow a professional for your investing or trading, or you become a full-time investor or trader, but don't do it, like midway. Is my suggestion.
And it's very interesting because you said that, quant will tell you when to enter, quant will tell you when to exit. That means usually even when a black swan event happens, like what we saw recently, that means your drawdown is going to be significantly lower than Nifty, because the Nifty panel is going to come and sit only after 6 months and say, boss, isko nikalna idhar se, right?
Exactly. The main issue that happens in the market from a behavioral perspective is that market is a regret-making machine. And I'll give you very quickly four examples. So you buy, you would have heard this all the time. You buy a stock drops. You sell a stock goes up. Very, very common, both of them. The third one is you sell a stock and the stock actually drops, but you say, why didn't I sell all of them? And you buy a stock and the stock actually moves up, and you say, why didn't I buy more of this? So anything that you do in the market, the market hits you back with a regret, and you start to question yourself that, Alok, you did not make a right decision. And that actually creates a very negative sort of, feedback loop, which keeps making you non-confident of your own approach. Whereas in a very systematic, structured approach, when you're doing, you're not blaming yourself for it. You're saying, I have followed the rules to the T. If losses happen, fine. The strategy will take care of it. So it's a very different kind of an approach when you do these kind of things.
And as you said, right, I mean, you also said that a lot of research has been done with respect to momentum investing and how it's been performing. And we've seen this, I think, a few years ago when a lot of people in the US or the Western countries were talking about quant-based investing, and now it's come into India, and obviously you've got it in a very beautiful fashion. But how long do you think it'll take for, or are you already seeing a massive penetration happening with respect to trusting quant-based investing or, investing in momentum strategies?
So definitely there's been growth in people who are following momentum investing and investing, but it's drop in the ocean right now. I mean, the massive, dinosaurs of the market are still going to do the conventional way, because see, from a fund manager perspective, what is he going to tell the investors? What is his plan? Is he going to buy stock just because they're moving up? It doesn't sound sexy at all. You need to find a narrative. You need to tell a story. You need to build some framework around it. This is going to happen in 3 years, although he may not be knowing anything what may happen in 3 years, but he needs to build a story around it. Here, there is no story. The story is basically the stock is moving up, hence I'm buying it. The stock is moving down, hence I'm selling it. So this is basically what we're doing. We buy stocks that are moving up. We sell stocks that stop moving up and are coming down. That's the entire thesis. And this is not, very intelligent when you tell somebody, right? This is like a fifth grader thing that, you're buying stocks that are going up and selling stocks that is going down. So nobody wants to believe you.
Yeah. That makes. I love the thing that you mentioned about stock market is a regret machine, because I think everyone here who's watching this stream would have faced that regret once,
absolutely,
at least once in their life. कि अरे यार और खरीदना चाहिए था या जल्दी बेचना चाहिए था, some of that, right? But that's awesome. I think there's one more question by Harshad Fadke. What he's asking is, when we buy a small case, the timing is not best for each of the bot script, right? Because as you mentioned, there's some slippages as well. Sometimes it's not good to get into that. And also the timing, you can never time the market. It's about being in the market. But when rebalance happens, the bot shares are bought around the ideal entry timing. So the losses, so should losses be assumed initially? Very, very good question from what he's asked.
So I think while the question has merit in terms of, some stocks may have run up while you're entering, but if you see it from a larger perspective, if you are having a long runway where the current intermediate move is not the only thing that you're looking at, the market will go up, next season it will come down, 2 years later it will go up. Over a longer period, this will not have any impact whatsoever. And that's what I've showcased in that live portfolio that I'm running, that even though I've started at the top of the market in October 21, I'm performing really well in that strategy because I've taken, that entire market moved down also into consideration. The SIP is coming at the top, SIP is coming at the bottom. Now SIP is again coming at highs. So all that will get taken care of. Don't try to micro analyze the situation. Just go with the flow. Yes, it may make a slight difference if you were to be very selective about, only picking the new stocks coming in, and you could do that. But then your buildup of your portfolio will become very small because you will be starting at a very low weight. Like only the new stocks coming in, maybe like 2 stocks out of 20 in the first month. So you'll hold only 2 at 10% total weight. And then you'll have to wait several months till new stocks come in. That'll give you a long runway of getting into the portfolio. And if suppose this year itself was a beautiful year, you'll miss that opportunity also. So my sense is that don't overanalyze that situation and go with the flow.
Yeah. So I think a good question. Yeah, Harshad. So I think don't over stress on that small loss that you make in the start, because it doesn't matter if you stay in for 1 year, 2 years, 3 years, then you will not even see that coming.
And just to add to that, what if you came into any product that was holding Adani? We are still holding Adani stocks in many portfolios. So somebody who came in 6 months earlier had already seen Adani stocks go up 300%, but he's seen now 400% more. So had he not taken that at that point and assumed that, the stock will drop, he would have missed the future rally on it. So the whole idea of coming into momentum is to leave your brain outside and follow the strategy to the T.
No, I think this is very interesting because when Adani did that first massive rally, right, everyone's like, okay, it's overvalued, P ratios off, let's not invest in this, let's not touch Adani. But then it kept going up and kept going up, right?
And it is still going up today.
It's still going up today. So I think from a quant side, Adani pickers won, but from a fundamental and value side, I think it is a big no from that side. So again,
one very quick anecdote I'll give you. Most people don't want to invest when stocks are near 52-week high, for instance. Correct. Conventional investors will move out at that point of time. Momentum investors likely are moving in at that point of time because the stock itself is telling you that I may become a multi-bagger from here. So you need to listen to what stock is telling you rather than the other way around, that you are assuming that my assumption about this company, my assumption about this sector, and hence the stock should do this. But in the other case, the stock is telling you that I'm ready to run. Why don't you run along with me?
Yeah, that's very interesting. So Alok, I usually ask this question to everyone in the end, right? Basically, what is your take on the current Indian market? I mean, future take on current Indian market, and what are the sectors that you feel are going to be very crucial in the upcoming years? I know in quant maybe that might not be a good question because you're very unbiased.
So from your perspective, my answer from my quant and stock and product based perspective is that I don't know what's going to happen and I don't really care which sector will do well at what time. But on a personal level, if I were to sort of have my own human bias, which has nothing to do with my products, I think we are very near a tipping point where as soon as we are able to get some handle on the US dollar becoming stronger, I mean, I think that is the instrument which is holding the entire world at ransom right now. Once the US dollar stops to rise and starts to tip over, I think emerging markets are ready for a run. I think India is in a very sweet spot. FII selling has been exhausted. Domestic buying has not been exhausted. So as soon as we get those headwinds out, I think we are about to run. And on technical basis, we are very near a trend line, which is coming from that October last year. And as soon as we cross that, I think a huge amount of momentum is going to start on the upside. That may or may not happen, but that's the setup right now. And the sectors, of course, real estate, autos, I think metals will have a comeback. I think commodities will do very well over this decade. So these are sort of my personal biases. If I were to sort of play these, but I don't do any discretionary investing, so this is useless for me.
This is a very, 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 very different take from what I have spoken, I think, last week and this week, right? Where one person's talking about, okay, different sectors, and you're like, but I don't care. I mean, it's all about the quant and strategies. Again, guys, first of all, I want all of you guys to thank Alok sir for coming here and giving
Thank you so much.
1 hour. And I think the knowledge that you are giving us, right? Obviously, you're a veteran in the space. 2 decades is a long time in the stock market. I think none of us can give this kind of information. So.
You're making me look very old by
No,
27 years of experience, but yes, I am actually. So the only takeaway that I want your viewers to take away from this session is start to think that, the market tells you a story and you need to listen to it. Be a good listener to the market. That's all I'm saying. I mean, even if you are doing your own thing, not doing momentum and you're doing fundamental investing, that is fine. But allow the market to tell you what it is trying to tell you, and don't go against the the drift of the market. If the water is flowing from left to right, don't try to row right right to left. Go with the flow of the market. If you've identified stocks and they're not yet moving in your direction, wait for the right setup, wait for the flow to go in your direction, and then you jump in.
Perfect. I think, again, once more, I think thank you, Alok sir, for coming here and giving this wealth of information out, which very few people actually come out and talk about the strategies and what's happening with the space. And also, we're all learning in this space. I think you're also helping the community grow. And also, Smallcase, thank you for organizing this so that a lot of viewers can also come here and upgrade their knowledge, right? Again, guys, you should definitely follow Alok sir on Twitter and on YouTube, right? And you should also follow the Smallcase page as well, because we'll keep coming and doing more sessions like this. And again, thank you, sir. I keep tracking you, so I'll keep looking at what strategies you're doing.
Wonderful. It was a wonderful session. I think very good questions also from users.
Yeah.
So thank you all who have attended this, and thank you, Shashank, and thank you, Smallcase team. It was a wonderful session. Thank you. Bye-bye.
Awesome. Thank you. See you guys. Bye.